Okay, so we're going to go over a couple of different things tonight. The first one is going to be how to prepare a budget. And what I really love about this week is that regardless of what level you are at a company, you will most likely participate in the budgeting process. So even if you don't go into accounting, you're still going to be part of budgeting. And so it's a really important skill to have, not just to be able to understand the company's finances, but to be able to take part in budgeting process. So there's some videos to watch, but we're going to walk through some of the exercises and talk about it. And then the other thing that we're going to do is we're going to talk about how to do variance analysis. So a budget, part of the purpose of a budget is a control document, so that when you can compare what actually happened with what you plan to have happen. So then if there's a difference between what actually happened and what you plan to have happen, there's a process that we can use to figure out what the difference was. You know, did we use too many resources? Did we pay too much for them? What happened? Why is there a difference between budget and actual? So those are the two things that we're going to do tonight. So this first part is learning how to put together a budget. And the homework becomes intricate because you have to go all the way through the process in the homework so that you can kind of see how all of the pieces fit together. But a lot of it is very iterative, but you do have to really think all the way through it. So the budget process starts with the sales budget. And the reason that it starts with the sales budget, see, there you go, that's great, Kiara. Into real estate development, you have to be, that's awesome. Did you say, hey, by the way, I already am learning this stuff? I love to hear it. That's awesome, awesome, awesome. So we start with the sales budget. And the sales budget is typically set by senior management or the owners of the company. They'll often be based on like historically what sales have been. Obviously, there are things right now, really interesting situation because I'm on the finance committee for our skating rink and we're trying to slowly reopen starting next month. And I'm always the one that, I mean, since I started there, it's been, well, we should have a budget for this. Where's the budget? Where's the budget? And they're like, well, we always know. No, you don't know without a budget. We have to have a budget. And the director was talking to me yesterday about them trying to budget the next 3 months. And I'm like, we can't budget this quarter. Nobody knows what this quarter is going to look like. But we are going through the process to try to figure out how much is, how much does it cost to run a sheet of ice? How much does it cost to, run the facility with 2 sheets of ice? How much do we expect to be able to have, bring in from having skaters on the ice? Who do we, there's just, I mean, we're going through all of this right now. So it's something that, yes, when we talk about projections, this is something that of course nobody could see. But historically, you can use projections such as how much were your sales last year? Like, are they cyclical? Because here we're looking at January, February, March. When you're putting together the whole year, maybe your sales are higher in December or lower in December. Ours was higher in the summer and lower in the winter. So when you're looking at a sales budget, you're looking at that historical data and trying to figure out what the sales amount should be. You're going to be given that information. It isn't something that you could just guess at. And at a company, it really would be, this part is like the top level and it's set by management. This is our goal. So here we have our goal. The first thing we're going to start with is how much do we plan to sell? Like how many units do we plan to sell, or how many dollars and how many units does that equate to? But we're always going to start with units and then take that and figure out, okay, if we're going to sell 1,400 units, what does it take to do that? How much material, how much labor? All of that is then going to get figured in for what do we have to be able to sell 1,400 units. So in January, we have 1,400 units that we think we're going to sell. In February, 2,200, and in March, 1,300. So that's 4,900. they sell for $50 per unit. And if you're wondering, well, what do we do if we have like multiple products? If we have multiple products, then you have multiple lines of items that you could sell. So I'm going to we're going to sell 1,400 units times $50 a unit. I have $70,000 that I plan to have in sales for January, 110 for February, and 65,000 for March. Okay, that part isn't hard, right? That part makes sense. Okay. So now we're going to look at cash receipts. So the reason cash receipts and payables get complicated is because with cash receipts, we're looking at sales from customers, right? So when we sell to a customer, sometimes they pay us cash. Sometimes we sell on account. And when we sell on account, sometimes sorry, Liz not being in a uniform is distracting. When we sell on account, then the customer is going to pay us later. And so depending on what those terms are, when we're looking at when is the cash going to come in, that's what we're doing with the cash budget. So when we look at this situation, and this would vary by the company, right? But when we look at this situation, we're saying, okay, we plan to have 84,000 in sales for April, 144 for May, and 108 for June. Okay, so right off the top, we're going to start with that. So right off the top, we're going to start with, here's our sales. But we're not going to collect all of that. That's not cash sales. Those are total sales. So now we have, in addition, sales are 50% cash and 50% on credit. So that means that every month we collect half of whatever the sales is in for that month. And then what happens next is all credit sales are collected in the following month. And in the beginning, we have accounts receivable balance of $10,000. So when we look at this, we're going to say, all right, we know what our sales are. Everybody else got it, but try log out and back in, go out and back in.
What happened?
Someone's having trouble logging in. I mean, clearly the meeting's working because we're all here, right? Oh, Julie's in. Okay, perfect. All right, so we have our sales. Cash receipts from, so we have we're going to add our ending accounts receivable, because that could be collected, right? So now what we have here is everything that could conceivably be collected in April, right? So we know that the cash receipts, we get 50, first of all, we get all of the account receivable from the previous month. And we get 50% in this case of our sales. So 42,000. All right, now when we go to the next month, now we need, what's my ending accounts receivable, or my ending accounts receivable at April?
It's 42,000.
It's 42,000. So I'm going to carry that amount back over there, half of my April sales. So I'm going to collect all of last month's receivables. the 42,000, and I'm going to collect 50% of the 144,000. Is this making sense so far?
Yeah. So the 10,000, we're assuming it was the accounts receivable from the prior month of
Yep, they said
March,
that.
right? Okay.
It says the April 1st balance in accounts receivable is
Okay.
10,000. They have to give it to you.
Okay. So that is the accounts receivable from March.
Yep, that
Okay.
was from March, exactly. So now at the end of May, our accounts receivable balance is how much?
72.
72,000, because we only collected half of May. So we have 72,000 in accounts receivable. We're going to collect that amount from last month, and we're going to collect half of the 108. So 54,000. So what we can see from doing this is now we know how much cash we expect to have come in from sales every month. And it can get more complicated than this. Like sometimes you'll have a problem where you collect 30% in May and 20% in June, or 30% in May and 20% in June, or 30% in May, 15% in June, and 5% is never collected. There can be all kinds of scenarios, but the process is the same. But you have to think. All right, are we good here? Let's see if we're good.
Mm-hmm.
Yes.
Wait, what did I do? Oh, see, less ending accounts receivable. How do they want to do it?
It was not supposed to be the 50% on credit.
Oh, they reversed it. Sales less ending accounts receivable. Cash sales is 42,000. Collection of prior month sales is 10,000. So here we did the prior month sales down at the bottom, and at the top we subtracted the receivable part. So here we're saying, okay, we sold $84,000 worth of sales. Right off the bat, 42,000 of that is receivable, not cash. So we're gonna take it off the top. Our cash sales were 42,000, plus we collected last month's receivables. And then in May, we sold 144,000. Plus we have the 70, right off the top, 72,000 of that is a receivable. We're not collecting that. We collected 72,000 plus the 42,000 from last month. And then for June, we sold 108,000. 54,000 of that is a receivable. We're not collecting it. We collected 54,000 and 72,000.
Okay. So it was just flipped in the reverse order then. Okay.
So now, that's how much we're going to receive from our sales. This is a selling expense budget. So now we want to figure out, we know what is coming in. Now we want to figure out, based on what we're selling, how much is our selling expenses going to be? Now, this is not the materials expense. This is expenses for things like the sales department, commissions, things like that. So we have budgeted sales of 90,000, 140,000, and 100,000. So we're going to throw those in. This one's easy.
Yeah.
Yeah, this one's easy. And then in addition, sales commissions are 10% of the sales dollars the company pays, and a sales manager salary of $9,000 per month. Okay, so yeah. Okay, made it a percent. So 9,000. Oh, that's nice. And then the sales manager, which is 9,000. And then don't forget the last line, or you'll wonder why. Total budgeted selling expense.
That happened to me.
Yeah, that's happened before. And there's one that often gets it because it's just long enough that it goes down to the very bottom of the screen. And so you don't even notice that very bottom line. And it totals for you. And so the problem's saying it's not done. And you're like, it is. And it has all green checks and it's not done. And yeah. I'm familiar with that one. Okay, this one we're going to figure out. We know how much we want to sell, how many units we want to sell. Now we have to figure out how many units, to sell that many units, how many units are we going to produce? Because the number that we produce is not going to be exactly the same as the number that we sell. So we know that in May we want to sell 250 units, and in June we're budgeted to sell 220 units. We also know that we want to have ending inventory that's 50% of the next month's sales. So for May, we want ending inventory that is 220 divided by 2, 50% and 50%. So we want 110 units in ending inventory. On April 30th, finished goods inventory is already 125 units. Let's see if I can do this one backwards. Because I've done them backwards my whole life. Because I think this is backwards. All right, so we're going to start out with what we want to sell to begin with. Well, maybe not. Add beginning inventory, budgeted sale. There it is.
It should be next month's budgeted
Yeah,
sales.
that's what I'm like, where's the budgeted sales? It's because it said add, which is a little weird. So the budgeted sales for the month, we plan to sell 250 units. We also need ending inventory for next month. See if I don't do this backwards. So not next month's budgeted sales. Oh wait, maybe they don't want us to do that. No, less, we want, oh wait, we have 125 units in ending inventory. We want budgeted ending inventory. So we need to do 250 units plus 110. Those are the units that need to be there at the end of May. So now we know we need to make 250, oops, that is the percent. Okay. Less.
Budgeted ending inventory.
Yeah, I'm looking for ending inventory. There it is. Nope. Budgeted. Now I need a calculator. Oh, wait. Okay, so
I think the first one should be the next month's budgeted
yeah,
sales.
I do too. I hate doing it the way this book does it. So this would be 220. Now, so this has to be, yeah, 220 plus 50% of that needs to be beginning inventory. So this is, so we're going to have, all right, so we have 110 units that we have to set aside, that we have to make so that we have them at the end of the period so that we're ready to sell at the beginning of June. We also are going to manufacture and sell 250 units, budgeted sales for the month. So we're also going to sell 250 units. So we need a total of 360 units. But we already have last period's what was left over. So last period it was 125, which is half of 250. So we don't have to produce that. So our beginning inventory, we started with 125 units. So if we need a total of 360 units and we already have 125, then we need to produce 235 units. Does that make sense?
It's a bit
Okay.
confusing.
So what we're saying is, all right, so we need to figure out what do we need for this month? So we know that we need 250 units because we're going to sell that many, right? We know that we want to have left in ending inventory half of next month's sales. So if we're going to sell 220 units next month, we want to start the very first of the month with 110 units. So now we know we have to make 250 units, plus we have to make that 110 units for next month. That's where we get the 360. So we need a total of 360 units, the 250 that we're going to sell this month, plus the 110 that we need left over for June 1st. We already have 125 units already made. On the 1st of May, we had 125 units, half of what we were going to need for May, half of the 250. We have that already in beginning inventory, so we don't have to make that. That's why we need to make 235 units. So the way this works on the chart is we say, okay, next month we're doing 220 units. Half of those are what we want to have in inventory, so we need 110 in inventory. We also need 250 units to sell. So we need a total of 360 units. We already have 125. They were sitting in beginning inventory. So we have to manufacture 235 units in May. Are we better?
Somewhat. I need a little bit more work on this one.
So it's kind of like, because they all work this way. That's why it's important to understand it, because the cash, the payables, the production, the materials, they all work this way. Okay, so what we have is, here's what we need. So let's say, let me see if I can do it this way. Here's what we need for May, right? We have to make 250 units because we're going to sell those. But we don't want to start May with nothing. So we always keep half, we manufacture half of what we're going to need for the next month, so that on the very first of that month, we have that available. So in April, we have half of this 250 already produced. We have 125 units left over. This 125 units is 1/2 of May, and we produced it in April so that we'd have it to sell on the 1st of May. So we have 125 units left over from April. Now, we also need to have something ready to sell on June 1st. So in May, we're going to produce half of what we need for June. And half of what we need for June is 110 units. So this is our ending inventory, ready to sell on June 1st. And this is our beginning inventory, ready to sell on May 1st. And so when you look at it in total, and you're saying, well, how many units in total do we need to produce? We have to produce the 125. We already have that. We have to produce the 250. We have to produce the 110, but we already have the 125. And that's where we get our 235. Does that make sense?
It makes a more sense now.
Okay, let me try it this way. In April, we manufactured everything we needed for April, and we also manufactured half of what we need for May. So in April, our ending inventory was 125 units. So sitting in April at the end of the month, I have 125 units. I have made those in April so that on May 1st I could sell immediately. Otherwise, on May 1st I'd be saying, well, I have to make the stuff for May, right? So I needed inventory to sell immediately. So my April inventory, my 125 units, comes over here. And so I start out with 125 units already made. Now I also need to make 250 units. These are already made. I need to make 250 units, and I don't want to start June with nothing. So I have to make 110 units for June. That's my ending inventory now. So when I'm done, I have my 250 units that I've made and sold, and my 110 still sitting here for June. The way I get that is I have to manufacture 235 units. Because I need the 250 plus the 110 left over, and I already have 125. Then over here, I have my 110 units that I'm going to start with. And then in June, I would say, okay, I have the 110 units, plus I'm going to need the 220, plus half of July.
50% of the next month's sales. The 110.
Yes, I got the 110 exactly by 50% of June. Now, are we better? Are we inching there? I told you, it takes a lot of thought. And there's going to be more that's just like this.
I need more coffee.
You know? Okay, this is fun. I want to show you, and I attached this. I tried to put it in the announcements, and I don't know why. Okay, so I want to talk about this. So for those of you who like formulas, the bottom's going to work. For those of you who likes the chart obviously is going to work. Oh no, this is okay. This gets better. The hardest part is knowing what to put in. Now with the little numbers that we're dealing with here, you can actually see the answer, right? So ignore that part. Okay, so the reason this method is so valuable is because if I am over budget on something or under budget on something, if there's a variance between what I predicted would happen and what actually did happen, there's a reason. And there's two pieces of that reason. There's what I paid, or the price, and there's how much I used, or the quantity. So if we're talking about labor, did I spend too much? Did I pay more than I planned? Like, was I supposed to hire people at, $15 an hour, but I have someone working at $20 an hour? Or did I use too many hours? Like maybe I used more hours than I should, and that resulted in overtime. So price or efficiency. It's important to know which, otherwise I don't know how to fix it. If it was materials, did I pay more than I had planned to spend on the materials? Did we not get as good a deal on it? Did our supplier, what happened? Did I pay too much, or did I use too much? And the thing about this is that this isn't just dollars and cents. It can also go to quality control because, for instance, this is going to sound crazy, but it's real. I had a friend who bought a house in a neighborhood, and after they closed and moved in, they found out they were in a really good legal position. They found out that they did not put the steel around the foundation on any of the houses in the entire neighborhood. Now, I'm sure that that showed up somewhere in a variance report. I'm also sure somewhere there were like piles and piles of steel that somebody had to be driving by going, is that supposed to go somewhere soon? I mean, kid you not, it's like, it was a nightmare. They sold the house. It was a nightmare. But a simpler example is, you know, if you go buy sleeping bags, you buy them by, you know, the amount of fill and everything in them, as far as like what'll, you know, is it going to keep you warm if you're camping in 40-degree weather, or do you want it for -10? It makes a big difference, right? You don't want to take a 40-degree weather sleeping bag out to -10. Well, what if they're using not enough material because they're not stuffing it the way they're supposed to? You know, or what if you went and you picked up the throw pillows and, you know, it's like you had to go, well, this one's a little squishy. Well, this one's very squishy. This one's hard as a rock. So there's quality control issues with it as well. But what we're going to do is we're going to look at a way to separate price and variance so that you can tell which one it is. And this is where I end up needing notes as we go, so I don't forget what we did. So the way I remember this, well, I would just pull it up if I was you and taking a test, right? The way I remember it is, it's just standard on both. On the right-hand side, and I don't know why I always go right to left. I have no idea why. So standard quantity times standard price. And then on the far left-hand side, it's all actual. So actual quantity times actual price. And then in the middle, I have actual quantity times standard price. So that's how I remember it. And here I'm just like AS for like as, or I'm not really big with mnemonics. The formula works out exactly the same.
Is the standard cost, that's what we're predicting them to be?
The budget, yes. Standard means budget. So the standard price is what we budgeted. So here we have on the right-hand side, we'll do it what normal people do. On the left-hand side, we have how much we actually used and how much we actually paid for it. In the middle, we have how much we actually used times what we planned to pay for it, what our budget was. And on the right, we have what we budgeted for use and what we budgeted to spend on it. The other thing that you should be aware of is if we were really looking at this, we're going to work with the information in the formula, but the way that it really works in the real world is you actually are starting down here. You're actually starting with your total variance. And that's on your, like the difference on your, you know, budget to actual. So when you compare your budget to your actual, this is what you get. And so that's where you say, oh, look, there's a variance, let's go investigate. And that's when you put it together and figure out price quantity. But we're actually starting with, if you add the price variance and the quantity variance together, that's what you see on your budget to actual report, the total difference. The other thing that you'll see when we work these is the reason it's important to understand it is because sometimes a favorable price variance can hide an unfavorable quantity variance, or the other way around. So you could have a small variance, but a bigger problem than you realized because you have, you know, one part, like you might have not paid as much for it as you had planned, which was great, but wow, where did the materials go? They're using way too much. So there's a lot hidden in here, which is what makes it, I understand, annoying to work, but fun.
Yeah, that's what I thought was kind of confusing going through the lessons, is that I wasn't sure how they came up with the different names and how they came up with the information afterwards when they would ask us like if we had spent less money, who made the mistake?
Got it. The biggest problem that I have with these problems, the way they are in the lab, is figuring out what dollars and cents go, like interpreting the numbers, interpreting the information. In the real world, you don't have that problem, but in here, I have that problem. So, and also, like, are we doing it by unit or total? So on the right-hand side, we have actual quantity. On the left-hand side, we have actual quantity times actual price. So on the standard side, here we're looking at standard quantity times standard price. And here we're looking at actual quantity times actual price. And this one's going to be actual quantity times standard price. So we kind of remember where we're going, right? Okay, so so then we just start filling information in. So when we look at this, we say, okay, direct materials, standard. The standard was 4 pounds at $2 per pound. So the standard was, so we have standard quantity. Oh, there, I could have filled that in. Standard price, actual quantity, standard price, actual quantity, oops, actual price. So we have the actual cost of direct materials used. So when we're looking at this, actual quantity, actual price, so we actually don't have to figure that one out because it tells us the actual cost of direct materials used is $525,000. That's the other annoying piece. So now we're saying, okay, direct materials, $8 per finished unit was what we planned. 4 pounds at $2 a pound. So our standard quantity was 4 pounds. And we made 61,000 units.
Which is 244,000.
244,000. See, I think I do this wrong every time I do this, and I've been doing this for years. The standard price is $2 per pound.
$2.
No, it did work. Okay.
Mm-hmm.
All right. So we budgeted $488,000 for the materials. Okay. Our actual quantity. So when we look here, we say, okay, our actual direct materials used, we actually used 300,000 pounds. And we plan to pay $2 a pound. So what we're doing is when you look at the two on the right, we're isolating the quantity. We're keeping the price the same and we're isolating the quantity. And when that's not 0. Why is that saying 0? That's not 0.
300. You have to add the 300,000 on the left. And
No, but it's not.
and the actual cost.
Crap, what did I just do now?
Oh, you deleted.
Right? I know I did. 202,
sorry.
I know, right?
244. I believe,
Like,
yeah, 240,
like,
244. And then the actual cost, right? You need to fill out the actual cost.
The actual quantity should be 300,000 on
the actual
Yes.
quantity is 300,000 because they use 300,000 pounds. But I put it in there. Oh, over here. Okay.
Yes.
So the actual quantity was 300,000 pounds. They are making us do it even though we have the answer. And the actual price was, so they're giving it to us. We'd have to figure it out if we didn't have it. But if we take the 525,000 divided into the 300,000 pounds, it's $1.75. Okay, so on the right two columns, we've separated the quantities. So now we can see just by looking at it that we used more than we had planned to use, right? And that $112,000 variance is a quantity variance. In this case, this is direct materials, right? So it's a direct materials quantity variance. Now the other question is, you're not done answering the variance question unless you tell me if it's favorable or unfavorable. So you have to think, okay, but it's pretty simple, because if we plan to use $488,000 worth and we did use $600,000 worth, is that a favorable or unfavorable variance?
Unfavorable.
Yeah, it's unfavorable. Okay, so now the next thing is, get rid of the annoying writing. So now the next thing is on the left-hand side. We have a $75,000 variance. These two columns on the left, we've kept the quantity the same. We've separated out the price. So we can see that we planned to pay $2 per pound. How much did we pay?
175.
175. So
Oh, it's favorable.
So it's favorable, exactly. This variable is favorable. And this is—
Could you repeat? I'm sorry. Could you repeat that?
So we plan to pay $2 per pound, right here.
Yeah.
We did pay $1.75 per pound. Or in total, we planned for it to cost us, if we use 300,000 pounds, it would cost us $600,000 according to our budget. We only spent 525,000. So is that $75,000, is it favorable or unfavorable?
Favorable.
It's favorable. So now the next thing that we're going to do is we're going to say, okay, let's look at the total variance. So the total variance, we're going to add those together, but it's tricky because we can't just add 112,000 and 75,000 because one of them is unfavorable and the other one is favorable. So what we really have is 112,000 unfavorable minus the 75,000 favorable. So we have a $37,000 variance. And is that going to be favorable or unfavorable?
Unfavorable, and it's going to be the total variance.
So what this tells us—
It's a 37 negative.
Yeah, pretty much.
I don't think, yeah, it is. I don't think we have to make it negative because we're saying it's unfavorable.
So
So-
Doc, how did you get 244,000 on the right hand side? I don't think I've covered this far out, but I'm just trying to keep up with you guys.
No, that's okay. We got the 244,000 by taking, we plan to use, let me write it out. We plan to use 4 pounds and we planned to make, and we made 61,000 units. So 61,000 units times 4 pounds each should be 244,000.
At $2. Okay, that makes sense.
Right, at $2.
Yeah.
All right, are we all good here?
Yes.
Yes.
I know you guys are like, I'm sort of good, but I don't remember being good, so I'm probably not good. Okay, so here we're just going to look at the information. We're looking for the actual total direct, oh, I wanted to say something back here. The way this would work is, in reality, we would be looking at our budget to actual and we'd see that $37,000 unfavorable variance. And that would make us go say, wait, something's wrong with the materials. Go figure out what's wrong. And this is what I meant by favorable variances and hide unfavorable variances. Because as you can see, we used way more materials than we planned. I mean, $112,000 worth more than we planned. We were just lucky that we made up $75,000 of that by getting a better price. We probably got a better price because we bought too much. So that's why even a smaller variance should be investigated, but that's also where we would start. We'd start at the 37,000 and then we'd say, go investigate it, and that's when you would find out all the rest. All right, we have output for the current period results in a $21,000 unfavorable direct. You want to know what is the actual total direct labor cost. Okay, so we have a $21,000 unfavorable rate variance and a $16,000 unfavorable efficiency variance. That's the same as quantity. Production for the current period was assigned $400,000 for the standard cost. So our budget was $400,000. We went over budget by $21,000 because we spent too much, we paid too much, and we went over budget by $16,000 because we used too much. So our total cost, 6, 7, 2, 3, is actually $437,000. Does that make sense?
Yes.
Yes.
Let's see if it's right. Or if I should have used a calculator. Okay, there we go. Not so bad so far, right? Still
No,
too-
not at all. So I've only read chapter 20 so far. I'm assuming this is like in chapter 21.
Yep,
Okay.
a little after probably. We're going through it pretty good. It was. I just text him back. Say Julie asked if he could do the tennis courts. He may not be able to do the tennis courts at whatever time you'd be done with Julie. Julie had mentioned. Julie was wondering. Not you, Julie. Yeah, Julie was wondering. Julie, do the tennis courts. No, take you at the tennis courts after you skate. Can you just figure this out while I do accounting? Because I'm not doing very well with it. Yes. Skate on the tennis courts. She actually is. We just bought those pick skates. I'm not incredibly insane. She already had boots, so we just bought the wheels. They're only a couple $100, but you can do all the way through a double axle on them. Okay, this is another. So we're gonna practice here. So here we're only looking at the cost variance. So what you want to, because you notice there aren't as many columns, right? So we're looking at the cost variance. So the cost variance were the two on the right. So when we look at cost variance, that's, no, I'm wrong, the two on the left. So we're looking at these. This is where we are in this grouping. okay? Because we're saying cost, which is our price variance. So we have our actual, and we're doing overhead. So actual overhead times actual
Variance. Variable.
and then standard, and then actual overhead by standard. Okay,
Is a standard, right? A standard.
yep.
Right.
Actual.
You put actual.
No, this one's actual, this is standard.
Oh, that's right. That's a new
Because we're
one.
comparing the cost.
Yeah.
All right, so the actual machine hours used were 5,400. Okay, so we actually used 5,400 hours. And those both go here because we're just looking at cost. That's what's different. The actual variable overhead per hour was $4.70. So our actual was $4.70. We planned the standard, which is our plan, standard was planned, was $4.55. So we planned to spend $24,570 on overhead. We did spend $25,380 on overhead. So we're $810 different than our budget. Is that a favorable or an unfavorable variance?
Favorable.
So we planned. if you
Unfavorable,
look-
right? Unfavorable.
Here we
Because
planned.
we spend
yeah,
more.
Right, we plan to spend $4.55 on overhead. We did spend $4.70. So now, is that favorable or unfavorable?
Unfavorable.
Yeah, this is unfavorable. And this will be our total cost.
I thought that the standard cost was SH, like it was supposed to be the quantity for the standard.
Okay, but it depends on, so if we're talking about materials, the standard is how many materials we purchased. If we're talking about labor, then the standard is like how many dollars we spent per hour. If we're talking about overhead, then we're talking about our rate, our overhead rate. So here our
Okay.
overhead rate was $4.55, like we calculated earlier in the course. That was our rate. So here, that's what we're comparing with price is the rate. If we were doing variable overhead and we were doing the efficiency variance, then we'd look at whatever the cost driver was.
Okay.
Hey, Doctor, will you be able to post any of those extra questions like you did for last week?
Yeah, I'll go in and do that. That was actually pretty easy. Were they helpful?
Definitely.
Okay, post extra questions. In case I lose my in the morning. Yeah, I'll do that when I go post the video in the morning. Okay, so now we're looking at the overhead for machine hours. And now we're going to do all three. We're going to do the cost and the efficiency. So we already know on this side it's standard and standard. And on this side it's actual and actual.
Sorry, Doc. On the last one, I'm kind of doing it while you're explaining it, and I think it was SH on the standard cost. On the first one.
On the one before, the one that I was asking?
Yes.
Oh my God, you're right. Oh, you're right. Total variable overhead cost. Because we're looking at, oh yeah, because we're doing
Yeah, from one side
Far
to the
right and
other
the
side.
far, yeah,
Yes. Mm-hmm.
good catch. And we have actual, time standard. Okay, so the actual machine hours used were 5,400. Okay, so the actual machine hours were 5,400. The standard machine hours, what we budgeted, were 5,950. The actual variable overhead rate was 470. The standard rate was 455. So when we're looking at this 2503, we're looking at the difference in hours. So I plan to use 5,950 hours. I did use 5,400 hours. So is this favorable or unfavorable?
Favorable.
It's favorable because I used less hours than I planned, which in this case is good. And this is the
Efficiency variance.
yeah, total variable overhead efficiency. Okay, for the 810, I did plan to spend $4.55 per hour. I did spend $4.70 per hour. So is the 800 unfavorable? Right. And that's my cost. Variable overhead spending variance. And so our total overhead oh, I see. They're calling the total the cost variance. That's why the other one's like that. Okay. Cost variance is what you'd see on your balance sheet in this case. So you have to be careful again because the 2503 is favorable and the 810 is unfavorable. So how much is my variance?
$1,693.
Yep. And is it favorable or unfavorable?
Favorable.
Mhm.
Which means positive, right? Like.
Which means good, yeah.
Mhm.
Well,
It negative means unfavorable.
well, right. Okay, so it does mean good, right? And that kind of favorable variance is good, right? However, when you're looking at the, it's just important to realize that when you're looking at the total variance, if it's favorable, that still is a variance that you need to go investigate.
Can you go back to number 2 again?
It's safe to say that you always subtract unfavorable from the favorable.
No, you're going to subtract whichever one's less.
Thank you.
Whatever makes sense under the situation. Yeah, you really have to look at it and think, okay, that's favorable, that's unfavorable. So how much is left? And then is it favorable or unfavorable? Yeah, it's a two-step thought process. Okay, this is just allocation and you're going to use this. We have done some of this and you're going to use this throughout accounting for a variety of reasons. But here we're saying, okay, we have 2 operating departments, mixing and bottling. Mixing has 490 employees and bottling has 210 employees. Our admin costs are $178,000. This is not something you haven't done before. So our mixing department has 490 employees and our bottling department has 210. So to allocate it, we're going to say, okay, if we're going to allocate by employees, we have a total of 700 employees. So 490 divided by 700, this is 70% of our employees. just to check. my
And then
numbers.
30.
And 30%. I just checked it to make sure, 'cause I'm retentive that way. So we know that the mixing department has 70% of the employees and the bottling department has 30%. So if we have $178,000 to allocate, we're just going to take for the mixing department 178,000 times 70%. So we're going to give 124,600 of that cost to the mixing department. And we'll give the rest, which is 30%. So 178,000 times 30% is 53,400. We'll give to the bottling department. And that's just allocating the cost. That's not new. Return on investment for each of these divisions. So what is the formula for return on investments? We're going to take
Net income divided by average asset.
So we're going to take our net income is 4,200,000 divided by our assets of 20 million. Is 21%. And here we'll take the 2467500 for net income divided by our average assets 14100.
17.5.
So one thing you should be aware of is if we're using average assets, which means that we should be taking the beginning plus the ending assets, adding them together and dividing them by 2. So if you had like assets as of December 31st, 1 year, and December 31st the next year, you're going to add those 2 together and divide by 2. Did you calculate this one, Liz?
Yes, it's 16.5. And that gets me because I put 18 and 17 and it was wrong. And I was like, okay, wait, why is wrong? And then I tried the 0.5.
Rounding.
Yes, we usually round, right?
Yeah, not with these. But it usually would tell you, right? Oh, assume a target income of 13% of average assets invested. I forgot this was here. Compute residual income for each division. I actually haven't looked at this in a very long time. So I have
Average assets.
target return, targeted income. So my average assets, what are we talking about? Oh, those assets. Oh, I have assets in each one. Okay. So my average assets for my cameras and, oh, we're just doing this for each division. And my phones are 16 and my computers are, and I want a 13% return. So if I want a why did it not calculate it for the first one? So if I want a 13% return, all I'm doing, here it's just calculating the income, that's it. So I'm just going to take 233,000,000 times 13%. So this one's going to be 3,029,000. Okay. Compute residual income. So my actual income, my net income was 615,000, 2171000. 1,000,000. I'm feeling like I'm in 8th grade. Less my target income. Wish this was Excel. So my residual income is just what's left over.
Mhm.
6150000 minus 3029000. And we'll just wait. That one's the same.
That's 0. Yeah, it's supposed to be 0.
Huh. I'm like, whoa, something's wrong. What's the
And that's
chance of
negative,
that?
yeah.
And it's negative, okay.
Yes.
I'm like, wait a minute. I wrote something down wrong.
That's 243,000.
Oh, because I have to close the stupid thing. It's like I'm trying to put a
I'm
negative.
sorry, 430. 240. What did I get? 243.
It's trying to get the negative in.
Mhm.
Okay. Yeah, it's like, wow, that can't be, the number can't be the same. All right, same thing here. Now we're computing profit margin. So what's the formula for profit margin?
Net income, sales.
So my net income, okay, my sales is 2,600,000. My net income is 962,000. So I have gross profit of 37%. So is that good? Is 37% a good gross profit to have? Yeah, for all of you that are just sitting there afraid to answer, there's a good reason. It depends. So with ratios, sometimes there's an industry, well, sometimes there's a standard that's like across all industries, like with the ratio and the current ratio. But with a lot of ratios, the only way you know if it's good or not is if you compare it to like an industry standard or benchmark against a similar competitor. Because like with profit margin, if you're a grocery store and you're making 37%, you're killing it. But if you're a jewelry store and you're making 37%, you're gonna die. So, I mean, it really depends. So for all of you sitting there going, I don't know, is this a trick question? I can think of both ways. It depends. Oh no, the rule of thumb is not 10%. Think if you were a jewelry store, would 10% be work? No. A lot of companies that I know, they want to double their money. I mean, it's like double it or it's not worth selling.
Mm.
My profit margin was a lot more than 10% when we sold custom cushions.
I would.
Yeah, but the other side is if you had an office supply company, 10% isn't, I mean, 10% would be phenomenal. Or a grocery store, because a grocery store is normally like 4 or 5%. So it depends. It really take Starbucks. What kind of profit margin do you think they operate with? They're selling you mostly water. I mean, seriously, it is. It's mostly water. They start with coffee beans, a little bit of coffee beans, a lot of water, and then they charge you $6. They've got good profit margins. All right, what's the?
What is it? Do you know?
I don't know.
Do you know what it is?
No. Oh, because just now. We're gonna have to go back in time. We can't use it right now. Right now they've been closed for almost a quarter. Net income's down 63.31%. Yeah, you know what? That's a good question. I'm gonna have to. Crap, all my students are doing vertical and horizontal analysis on Starbucks. It's gonna look really weird next year. We're gonna get numbers where all of us are like, no, that can't be right, and we're gonna be recalculating it. I'm gonna have to get someone to do a solutions manual. Oh my gosh. What is the formula for investment turnover?
Oh, Sales divided by average investment asset.
So we're going to take sales divided by average invested assets, which we would, if we didn't have a total number, we would take beginning plus ending divided by 2. So they told us we have sales of $2,600,000 and our average invested assets are 2 million. So 1.3. Now notice the investment turnover is not a percentage. So that's the other thing. On some of them, they're percentages, and on some, you know what, I'll add a really good resource. I'm not sure if I have it in the announcements or not. I'm gonna give you guys a ratio sheet as a resource. And the really good thing about it is it's one of the best that I've ever seen. So I would keep it because you're gonna use it in lots of classes, not here necessarily, except for plugging numbers in. But the thing that's so amazing about it is on one side, it tells you the industry average, if there is one, and it explains the ratio. It explains what the ratio tells you and whether you want it to increase or decrease if it were to improve. And the reason that's important is because here's how I understand, and then we'll go. I know it's late. Here's how I understand ratios. If we take this top one, we have net income divided by sales. If I wanted to know, well, how can I, first of all, 37%. Improving would mean increasing it, right? Ideally, I want my profit margin to increase. So what I really have in net income is sales minus expenses. And on the bottom, I have sales. So if I increase sales, am I going to change my profit margin? Right, if this goes up and this also goes up, do I change my profit margin?
Yes.
Mm-hmm.
But if I can make this go down, it's going to have a bigger impact.
Expenses. Mm-hmm.
Because sales are on the top and the bottom. That makes sense?
Mm-hmm.
Because what we're really looking at with profit margin is how much do we put in our pocket after we pay all of our expenses? How much do we put in our pocket after we pay all of our expenses? So you have to, if you separate out the top and the bottom, then you can pretty much cancel out anything that's on the top and the bottom, and you'll figure out exactly what moves that ratio. It also helps you understand what it means, what it's telling you. Okay, how do you feel about this week? This week wasn't as bad as last week, was it? Okay. You're like, oh, there's a catch. Some of the quiz review gets messy because of the periods, trying to figure it out, but other than that, we're good. You guys will be easy with it because you're you're good with the numbers. Okay, I will see you on Thursday. If you have questions about your quiz, call me. The grades were really good. I mean, overall, the grades were phenomenal. I was incredibly impressed. Made me feel like you're learning something, which is how I like to feel. So call me if you have questions. And other than that, I'll see you on Thursday.
Doctor, I do have a question.
Mhm.
Was the prompt for the course project put into this week because it's your intention that we start on it this week?
You can start on it. Yeah, that was the intention. And that if you want to start on it this week, you can. Some teachers, some faculty have it due like the middle of next week so that they have time to grade it. But well, it's really easy to grade, and I'd rather spend the time grading and have after the course ends and have you have more time to write it in general. But this one's really easy. Literally, it's go to the website, answer the questions. All I'm looking for, it can be in question answer format, and all I'm looking for is complete sentences. Well, and-
Okay, great.
and
That was
good
my next
grammar.
question is, did you want it in APA format? But I guess question answer is good too.
Yeah, I don't think there is. Yeah, you can't, don't make it into a narrative. It won't, it would be an exercise in uselessness to try to make a list of questions and answers into a paper. It's not designed to be a paper. So as far as APA, I mean, the only thing you can do is cite your source, but you don't need to because I told you where to go. And so because I told you where to go and that's where you're going, you don't have to reference it. So this one's pretty simple. Okay, does that make sense?
Yes, thank you.
You're welcome. So yeah, so go start doing that, but it's not gonna be, but you have the final exam next week. It's not gonna take you a long time to do the paper. Probably find it on the internet because I don't think the assignments have changed in a long time either. But it would take you just as long to type it off as somebody else's than it would to look it up. So now that I think about it, okay, I will see you on Thursday.
All right. Have a good night.
Bye. I'll post the video in the morning and extra questions.
Thank you.
You're welcome.